Thank you for coming to the first full year results announcement for Meridian Energy as a public listed company. It's been a challenging year with the renegotiation of the TY Point smelter contract in August and then the initial public offering in October, with the following pressure to deliver on the forecasts contained in the prospectus. It's therefore pleasing to be able to announce that the company has exceeded the forecasts contained in the prospectus on all key financial measures. In addition, the very good cash generation has enabled the directors to declare a higher than forecast dividend for the year. This has all been achieved while the company has made solid steps in our commitments to health and safety and investment in our communities. During the year, we had one minor LTI, which is the first since September 2011, and also our total recordable injury frequency rate increased marginally. While this is disappointing, I've never regarded these measures of having any correlation to safety culture or the chance of a serious accident. So the highlight for the year was actually an external audit that we had done that looked at our attitudes to safety and our processes and procedures. This audit had very positive comments around our safety culture and attitude, and generally around our procedures. Although, as you'd always anticipate, there are some procedures that we've been asked to review, and there are improvements that we can make in our reporting. So those will all be completed and attended to this financial year. Okay, the numbers, and you guys are probably over the top of this already, but it's numbers on a page, and I'd like to take a brief time to comment on each in turn. These comparisons are, of course, against the forecast provided in the prospectus. And when we get to the financial performance section of the presentation, Paul Chambers will take you through a comparison to the previous financial year. Trying to do both at once is just a bit too difficult. Men can't walk and chew gum. First, our EBITDAF. This was 585.3 million, or 6.7% above the PFI forecast, broadly in line with the market guidance provided in February this year. EBITDAF benefited from a higher energy margin in New Zealand, where we saw corporate and industrial pricing hold up better than expected, and overall volumes in this segment up for the year. This was offset somewhat by the higher contracted sales, which meant we had less to sell on the spot market, and the cost of having to acquire generation when it went dry from mid-January to April. On the cost side, transmission costs were down 6 million on anticipated costs, and operating costs were down 7% on forecast at 236 million, reflecting the benefits from organisational changes and corporate savings. Net profit after tax was 22%, or 42 million up on the PFI forecast at just under 230 million. This was a result of a number of factors, but the largest being the higher operating earnings and a gain on sale on fixed assets of 6.6 million, plus positive non-cash fair value movements. These were offset by a higher tax expense arising from the higher earnings. We provide the underlying NPAT in the belief that it allows a better comparison of year-on-year performance, as it backs out one-off and infrequently occurring events, impairments and fair value movements. On this basis, underlying net profit after tax was 195 million, or 21% up on the prospectus forecast. It was very pleasing to see very strong cash generation in the year. This arose from the strong operating cash flow of 433 million, which was 94 million up on forecast. In addition to the improved operating result, this figure also benefited significantly from the closeout of the aluminium hedges that were no longer required under the varied TY Point contract. This solid operating cash flow position was further enhanced by outwards cash flows from investing activities being less than anticipated, and by the sale of surplus assets, principally land associated with the suspended North Bank Tunnel project in the Waitaki River Valley and the sale of our solar farm in California. This healthy cash position has enabled the directors to declare a higher dividend than anticipated in the PFI, which I will now elaborate on. Leave that one, Paul. Move on to dividends. The directors have declared a higher dividend, declared a dividend for the second half of the financial year of 6.82 cents per share. This brings the full year ordinary dividend to 11.01 cents per share and represents a payout ratio of 75% under our dividend policy of paying out between 70 and 80% of adjusted free cash flow. In addition, the board has declared a special dividend of 2 cents per share, funded from asset sales and aluminium hedge proceeds. Both dividends will be imputed to 90% of the corporate tax rate compared to 72% in the PFI. This delivers a total dividend for the year of 13.01 cents per share compared to 10.5 cents per share forecast in the prospectus. So it's nearly some 24% ahead of where we had forecast it. And it provides a gross yield of 17.6% for the year on the $1 paid on the instalment receipt at listing, and a 11.7% yield if it was assumed that the full $1.50 payable under the instalment receipt structure had been paid on day one. Management and the board recognise that strong cash flow and the resultant relatively low debt levels means the company has the opportunity to consider whether it has the optimal capital structure. Accordingly, over the next 6 months, we will be reviewing possible alternatives, which could include a share buyback program or further distribution by way of special dividends. I'm at pains here to point out that nothing has been decided at this point, and there are 3 matters that could materially influence the view taken on the matter. The first is the election in September, which may lead to a change in government and material changes to the structure of the electricity industry, the impact of which it is impossible for us to predict. The second is the option that New Zealand Aluminium Smelters has to issue a termination notice under its contract with Meridian on 1 July 2015. Should NZAS elect to leave, this will inevitably lead to a period of uncertainty in the industry while the underlying position of the major players in the market is resolved. And thirdly, as we continually state, earnings can be materially affected by a number of issues, not least of which is hydrology. So any decision will be dependent on trading in the period through to February and the outlook at that point. And just to make it clear, we will be commenting on this issue at our interim results announcement in February. Right. Returning to general highlights for the year. It was generally a good year from a hydrology point of view, with the highest June year inflows since 1998. However, as usual, there were marked variations, with 3 months having inflows greater than 180% of average, and the late summer period proving very challenging, with the 3 months of February, March and April being approximately 62% of average. This required us to acquire generation at a time when wholesale prices were firming. The retail market remained as competitive as ever. MB data comparing residential sales data for the March 2014 year showed that in this period, Meridian's residential sales prices, including transmission and lines charges, decreased by 0.3%. And this is despite a 1.7% increase in lines costs. This reflected the competitive market environment in acquiring new customers and retaining existing ones. Given there is not a lot of growth in the current market, we've had the focus during the year on continuing to get the basics right. So it is pleasing to note that underlying operating costs, after taking out IPO costs, were down 6.1% in the year. We have also focused on identifying land that is surplus to requirements, and we are partway through a 2-year land sale program that realised $41 million in cash this year and will be completed in the current financial year. Both of our large capital builds, the Mount Mercer Wind Farm in Victoria and the Mill Creek Wind Farm in Wellington, will be completed this financial year and should be delivered under budget. Mount Mercer has had all turbines operational since the 20th of June this year, and all Mill Creek turbines should be commissioned by the end of September. As at today, there are about 17 of the 26. In Australia, Powershop's entry into the Victorian market saw 13,400 new customers signed up as at 30 June, which is some 2,000 more than was noted in the prospectus. While the market is very competitive, the positioning of Powershop as an independent retailer with green credentials and a differentiated service offer is appealing to a growing number of Victorians, and you might have noticed that Greenpeace actually announced on Thursday, I think it was, that Powershop was the greenest energy company in Australia. Over the last few years, we have critically evaluated the viability of a number of our development opportunities that the company had on its books. A key focus for this year has been extending the length of those options with landowners, or those options that we retain. For some time now, we have been considering the future of our metering business, ARC. New Zealand has 3 metering businesses, and ARC is the smallest, with approximately 7% of the market. And when it was unsuccessful with the bid for the deployment of meters for Trustpower, it was appropriate that we consider the business's future, given its capital requirements and the lack of scale growth opportunities. We are currently going through a process to ascertain whether there is an appropriate purchaser for this business, and hope to be able to make a final decision on this matter sometime within the next few months. At the same time, we're in discussions with parties regarding the deployment of 129,000 smart meters to those of our customers who are still on legacy meters. Okay, that. Retail. Aggregate demand is, as you can see from the graph, flat at the national level. However, when this is examined in more detail and you factor in the growth in embedded generation of approximately 150 gigawatt hours per annum over the last decade, some interesting features stand out. In the last 3 to 4 years, it is the reduction of consumption by major industrial users that has weighed down overall demand. Provincial New Zealand has actually seen reasonable growth, whilst urban demand has been flat. So it'll be interesting to see how GDP growth and the quite significant net migration we currently experience shows up in future demand. In a tight market, our customer connections increased marginally in the year by 1.7%, and the total retail sales improved by 1.6% in volume terms. Retail has been going through significant change this year, and is now 1 year since Alan McCauley was appointed General Manager. In that period, we have been overhauling our customer-facing processes to ensure that we can deliver services to customers on time with correct detail and at the best price. While we were rated by Consumer Magazine as the best of the Big 5 gentailers in its July survey, we've further to go in this area, and we continue to invest in improved systems. On a segmental basis, residential, small business and agriculture revenues increased by 1.7% in the year. This was despite a reduction in the overall prices received from residential customers and reflected an improved mix of customers in the business and agricultural sectors. The corporate segment saw prices fall as contracts were renewed, reflecting the fall in the ASX futures market. If the demand-supply gap closes, we would expect ASX to quickly rise and corporate prices to follow. Quick one on hydrology. Inflows into our lakes were 111% of historic average, but as already noted, we had a very dry February to April, which coincided with operational factors in the South Island, such as the closure of the Tekapo Canal over the period, and made wholesale trading difficult. The bottom graph, which shows our Waitaki storage position in the dark blue line, is this year, illustrates that our current position relative to a range of other years is actually pretty good, and the storage position going into the current financial year is more than satisfactory. Generation. Meridian's generation totaled 13,137 gigawatt hours and was up nearly 9% on last year, with significant fluctuations in weekly market share, as you can see from the lower graph. At times in between December and March, market share was between 40 and 45%. However, prices were weaker than last year, on average by over 7%. Hydro generation was 90.5% of the total, but it was pleasing to see the wind generation increase by 8% in the year, excluding the contribution made by the partially completed Mill Creek. The only disappointing aspect of the generation story was the lower hydro availability and forced outage factors for the year that arose from 2 transformers being taken out at Manapuri as a result of aluminium filings from the coolers contaminating the transformer windings. New transformers are on order and they will be replaced by April next year, and as we've already said, we do not see this having any material effect on our financial forecasts. So I'll now ask Paul to talk through the financial performance section.
Thanks, Mark. Mark's talked to you about the performance against the PFI, so I'm not going to cover that. I'll really focus on performance against last year and some of the details behind those headline numbers, and then just look at energy margin and the other components of the result. So against last year, a flat EBITDA actually looks quite good from our perspective, and the reason for that is pretty evident. Last year we saw the benefit of two big items that weren't repeated this year. The first of those was we had 6 months of uplift on the NZAS contract, so that was on the old new contract before it became the new contract, or whatever terminology you want to give it, but we had a kicker for 6 months and then it fell back down again. We also benefited from 5 months of earnings from the Macarthur wind farm before we sold it at the end of June. And together those items added up to just shy of $69 million. On top of that, obviously we had the impact of costs associated with the listing, both this year and last year. Once you strip all of that stuff out, the underlying EBITDA was 14.4% ahead of last year, and that's despite a lift of $14 million in transmission costs associated with the completion of the DC works. At an NPAT level, quite a lot of noise around non-cash fair value movements, where although we saw a gain of nearly 20 million, last year we had a larger gain. And of course, last year we also had the benefit of the gain on sale of Macarthur of 101 million before tax. So stripping all that stuff out and going to underlying NPAT, we saw a lift in underlying NPAT of nearly 20%, and that's despite the flat EBITDAF, and that's entirely attributable to the reduction in debt associated with the sale of Macarthur, and therefore the lower financial charges. So just going into the 14.4% like-for-like increase, obviously the biggest influencer was the higher inflows than last year. So we had a lot more to sell on the wholesale market over and above our fixed price contract obligations. We also saw a reduction in the amount of acquired generation required to cover dry periods with that additional water, although, as Mark said, it got a little bit hairy and tense for a while, just after we'd issued guidance when it went very dry, and we did obviously buy a bit of cover there, and you'll see that later on. The second thing, operating costs, so 6.1% down on last year, excluding listing expenses. And then the third item was that Mount Mercer started kicking in towards the back end of the year and contributed nearly $10 million to revenue from early production on the early strings. I won't really dwell on cash flow. Mark has taken you through this. Just to reiterate that $94 million ahead on operating cash flows, of which 54 came from the closeout of aluminium hedges, and then gains on the sale of US operations and surplus lands to the tune of 62 million. Our net borrowing picture end of year compared to the PFI is slightly better than that, because there are also some timing impacts, particularly around the spends out on Mercer and Mill Creek when the cash actually goes out the door, and tax cash flows associated with the MacArthur deal, which we would have expected to have flown out by now, which haven't. But it's still a pleasing position, and obviously has underpinned the dividend position that we've taken. Just talking about energy margin, there's just a reminder of how we think about it. Fixed price book, what's left over, and then the cost of hedging our dry year and seasonal risks. And looking at that against last year and then against PFI, slightly different pictures. Against last year, you can see on retail, excluding NZAS, pretty much flat, and that's lower pricing on the C&I market and residential, offset by higher volumes and a better mix in that SME and agri sector. Then you can see the big negative number there, which includes the amended NZAS contract and lower derivative sales. Last year we were selling out of quite a big buy-side position, which we developed in the previous dry year, and that influenced that. And on the net spot exposed revenue, as I said, a lot more volume. We had lower prices on the volume we're selling and lower prices on what we had to buy, but overall it was just the extra volume we put to market which influenced that positive 82 million, and a lower cost of acquired generation with the slightly wetter conditions. Against PFI, it's a slightly different picture. We saw C&I prices, as I said, reduce significantly, but not as significantly as we thought. They held up a bit better. We saw a bit of firming in ASX, and we saw ourselves able to get a little bit more margin out of offering energy services, etc., into that market. We also saw bigger volumes, both in that market and in derivatives being sold compared to that PFI number. Those bigger volumes meant we had less to sell on the spot market than in the PFI. And as Mark said, we had a little bit of extra cost of acquired generation compared to the PFI, really because of that scary period there. So net up $11 million on year. On the cost side, good progress on the parts we actually control. The transmission costs really obviously reflecting the big recent investment in the HVDC, and that's still an ongoing story. But on the rest of it, nice to see us $18 million under PFI, with some really good work inside the business to drive efficiency and reduce our cost to serve. Now, going forward, obviously the growth of PowerShop in Australia and the new wind farms have associated costs. But what I can say is that we're targeting for costs this coming year, excluding those items, to at least match where we got to this year. We want to counter any inflationary pressure, and we've had success in the past, as you can see if you look at the 5-year trend. Now, you've got lots of supplementary stuff and you've got the full accounts, so I'll leave you with that, and I'll pass you back to Mark. We'll just wrap up before you get a chance to ask questions.
Thanks, Paul. Clearly, we're starting the new financial year pleased with what we've achieved in our first 8 months as a listed company. However, our priority is delivering on the forecast and the prospectus for the FY-15 year, both in terms of earnings and cash flow. At an operational level, resolving the path for our metering business, ARC, and allocating the deployment of approximately 129,000 smart meters for those customers still on legacy meters is a key issue for us. On the capital investment front, we are nearly finished our 2 major capital projects, Mill Creek and Mount Mercer, and at this point we do not expect any further capital expenditure in FY-15 other than our stay-in-business CapEx. At the strategic level, the year ahead will, however, see NZAS make a decision whether or not to exercise its right to issue a termination notice under our electricity agreement on 1 July 2015. Should it do so, it would likely close Tiwai Point as at 31st of December 2016. This decision will undoubtedly hinge on the international aluminium price, the New Zealand dollar against the US dollar, and the operational and strategic fit of Tiwai Point in the Rio Tinto portfolio. While the price of aluminium on the LME, London Metal Exchange, and the various premia available to manufacturers have improved over the last 12 months, the New Zealand dollar is still higher as against the US dollar than it was 12 months ago, despite significant weakening over the last month. So it would be inappropriate to make any prediction on NZAS's decision on the matter. On the regulatory front, we are expecting more clarity on a couple of significant matters in the coming year. In New Zealand, the Electricity Authority is continuing with its consultation and deliberation on the issue of transmission pricing and is due to deliver a further issues paper by June 2015. Which we are hopeful will outline a preferred and definitive way forward. With the delays to date, we do not believe this matter will be resolved until 2018 at the earliest, unfortunately. Across the Tasman, we have seen the Australian Government establish a review of the RET, or Renewable Energy Target. This is the scheme that underpins the renewable industry in Australia. And should this review lead to a significant change in the scheme or its repeal, it will adversely affect renewable energy industry in Australia to the point where further investment may not be viable. The review should be completed and submitted to the government within the next few weeks, but a political decision by the government as to what it intends to do is not expected until sometime between September and December. This position is further complicated by the politics in Australia, where the Palmer United Party, or PUP, has indicated that it will veto any legislation aimed at repealing or modifying the scheme. This has led to a very unsatisfactory state of affairs, where all players in this segment are sitting on their hands, waiting to see whether this sector, which has added billions of dollars of investment and thousands of jobs to the Australian economy, has a future. In our home market, it has been well publicised that should Labor and the Greens form a government after the September election, they intend to make changes to the New Zealand electricity industry. Just what might materialise is still not known, but we're ready to work with whoever is in government and have already indicated ways in which the industry can be improved. We're already seeing good progress in competition and transparency that we can build on. So in summary, a very satisfactory for the year, where we have achieved what we said we would do and capped this off with enhanced distributions to our shareholders. This current year will undoubtedly provide its challenges, but at this point we have no need to revise the forecast earnings figures for the FY-15 year that are contained in the prospectus. And with that, I will invite questions